Hey, everybody. Hope you're all good. Um, I am doing very well indeed. Today we're talking about trading ranges. So we're just gonna plow right in. So yeah, with that, I find I'm quite excited about today. Not just because we're talking about trading ranges, and I'll tell you why, but because after it's almost 3 months now that we've all been plugging through price action and talking about price action. And I think with the conclusion of today, we would have come to a stage where we can really now just start looking at trade. So going forward, my primary focus will be looking at trades and bringing all the strategies together. Now, as the market tends to be, in the hour of the show, we may not get all the setups, but I'll be primarily focusing on what has happened from the morning, from the Asian session on a Wednesday, and also the couple of days before, so we can see where our strategy is set up, where if we were in the market, we ought to have traded, and how we ought to have traded. So you just have to keep the questions going. But be that as it may, like I said last week, we are in the beginnings of what looks like it's going to be a very cold winter here in Johannesburg, South Africa. Rather, the whole country is experiencing winter. And because it's cold, there's a lot of power cuts and power sharing and all sorts of things that are happening. But I think I'm a little bit spare data dongle right next to me. So if the primary one goes down, just hang in there and we'll jump straight back in. So that should keep us going. So what is cold, I guess you're asking. I mean, a couple nights ago, we hit just dropping to 5 degrees at night Celsius. Now that's cold for us. It may not be cold for some of you guys, but that's freezing. So you can see all this gear that I've on just to stay warm. In any case, so we're looking at trading ranges, how to trade trading ranges. One of the reasons I'm pretty excited about what we're going to be talking about today is that for a long while, I absolutely hated trading ranges because I just could not put my mind around them. Whenever I analyzed my results, I would find out that I lost a lot of money in trading ranges. So I just made a decision. I hate trading ranges, and I'm not going to trade them. And that worked well, but I realized I was missing opportunities, so I really invested some time in seeking to understand trading ranges. So here's the principle. Trading ranges occur continuously in the market. That's something we have to accept and live by. The market is continually creating and making trading ranges. That's part of it. There's no ways you can avoid them. And they come in different forms. You can get very tight trading ranges, and I'll show you some of those as we scroll back, where unless you're super fast in making decisions, the best thing when you see a tight trading range is to understand what's happening and wait for the market to break out of that tight trading range. It can also come in very broad forms, which allow you to trade and make decent money from one end of the trading range to the other end of the trading range, or to anticipate that the market may break out, test, but carry on in the direction that you originally took the trade. So they occur in that form. They occur when the market is changing direction. Typically, we've spoken about the major trend reversals. They're usually preceded by a trading range of some sort. Now, I'm not talking about the reversal at lead and support levels, which we spoke about. That one typically will not form a trading range. So if you see a reversal occurring at a hidden level of support, you need to just make a decision where you're going to enter, where you're going to put your stop, and just jump into the market. Otherwise, you will definitely miss out on the opportunity. But the major trend reversal, remember, break of a trend line, attempt to break to moving average, that particular strategy typically results in a trading range. The trading range on breakout may become a trend reversal. Remember, trend reversal strategy is 40% success, and if it does work, it can go a long way. You can make money on the original entry, you can make money on building a position. But they can fail. So if a major trend reversal is 40% successful, it means 60% and 40% successful, 60% of the times you're going to fail. So you have to be very careful how you trade those trading ranges. Don't just jump in and say, well, I'm just going to jump in and it's going to work. It won't just work. So what are the principles of a trading range? You need to see two clear, distinct touches. Okay, you need to see two clear, distinct touches at or around the same level that provides you the base of the top of a trading range. And once you have a base or the top of the trading range, then what you're looking for is your entry. Okay, if you have, let's look at this. This is today, right? This is today on gold. This is what just happened on gold. So two touches. There is the first high. There is the second one. Okay, slightly above, but that's not a problem. So whenever you see the two touches, that creates for you a top or a base for the trading range. You may not have had a second one yet because at the bottom it will come later. If this is going to be a base of a trading range, you will get another double bottom here, whether it's at the same level, just above, then you know, okay, now I have a trading range, my breakout either way. But once you see a trading range like that, then what you're going to look for is a lower high. Okay, and if you're starting to trade trading ranges, you want to find a lower high where the bear candle, in this case, closes beneath the moving average. Okay, so we just aiming to be a little bit more prudent, a little bit more safe and wise. The top of the trading range in this case provides you where to put your stop. Your stop is going to be above this level, plus whatever, 1 or 2 pips, whatever you put. It has to be there. That's the correct place to put your stop. Then you wait to look for a lower high and a decent close beneath the moving average. That could have been one to take a trade. If you're not triggered in that, then come out of the trade. When I see a setup and when I see the candle that I want to trade, then I want the market to go my way after I place my order in the market. If it doesn't, I just take the order out and I wait. If it turns and goes against me, that's fantastic. Because you're always going to be asking yourself, hey, there's a beautiful setup here for the trading range. There's a lower high. So the bears who managed to stop the bulls from going up and created this double top, they ought to be strong enough to get the market moving in that direction pretty rapidly. So if they didn't at that particular point, you got to ask yourself, well, why not? Because I'm following the big money, the major institution. Why has that not occurred? Then just pull it off and wait. So you wait for the next opportunity. The next opportunity has presented itself right here. Okay, there's a decent enough. It's a lower high from there. It's a little bit of lower high from there. Place an order beneath that. I think you have been triggered there. If not, wait. But if you are fantastic, your stop is up here. They've been triggered, and once you get triggered based on your strategy, you wait. Okay, even if it turns against you after you have been triggered. Why would you wait? You may ask me after not waiting here if you're not triggered. Well, simply the bears were able enough to trigger the sale. Bulls are fighting, so that's fantastic. We're in the trade. If you didn't take that, you could take that one again, triggered, and hold your stop against that, decent enough. If you didn't take any of those because you were just a little bit more cautious, you say, okay, I'm going to wait, and then you see this, you better put your entry beneath that. Okay, you put your entry beneath that, you stop there. But then again, you don't get triggered. So what do? You take the trade off. You take the order off. Now you see that. And here's what I'm going to say at this stage. You're waiting for a lower high. You didn't get triggered in here because you didn't take a trade for whatever reason. But you see that and you say, oh, beautiful. And it's not triggered. You pull out your order from the market because of the question, why did they move in direction? Then you get that. Don't put your order there because now you're now we're halfway between the trading range. That's a high, that's a low. Okay, the market could go your way in 10. So if you miss it there, you're just going to have to wait and keep your analysis of the market going. If you're still in the market, hopefully something else will set up. So we go to the bottom. Let's open the day. Let's take it out. Okay. Remember, you always draw these lines before the market goes there. What's the market likely to do? If it gets to this low, just draw a line and see what happens. As soon as the market got there, the bulls defended that pretty strongly. An immediate two-bar reversal, beautiful, but you're not going to initiate any reversal trade at the bottom of a trading range. Okay. Then we get a breakout candle, but no follow through. But the market is still going down, which is perfectly fine. We have another breakout candle breaking beneath that. Very poor follow through, but it's still a breakout. Now, we're just waiting for a way to get back into this market because the bears are strong. Breakout, let's see what happens at the test of the breakout point. We get this decent pattern here, inside candle. I've spoken about that before. That's a breakout mode, which means market will break out in one form. There could be a failed breakout or there could be a successful breakout. So in this case, you could put your entry beneath this inside candle, almost inside candle. Okay, right there. But where is your stop? Your stop now is at that lower high. Why? Because from that lower high, the market broke to a new low and pulled back. That's where you put your stop. Okay. And as it turns out, you did not get triggered. So you wait again and see what happened. Now you've got that lower high, which is a significant lower high for yourself, failed breakout, another lower high. And the thesis for the bears is still strong. So let's wait. Then when you get that, there's an opportunity to get in. You could put the entry beneath that. Get triggered. If you didn't take that, there's another entry. And just but the point you're trying to get to is trading ranges. So your entry would have been anywhere within here, there. You have given the entries, and then all the way down there. Okay. So let's search for trading range. Now here is a clear example of a tight trading range. Okay. The tight trading range occurs when you see very little opportunity for you to trade. It may look like it's setting up, but if you take a trade, let's put the full range of that trading range in. I was just going to end it. And where are you going to trade in there? Okay, a whole bunch of double tops, lower highs. But remember, when you take a trading range trade, your first objective is to see what happens at the extreme, right? And you're taking a trade roughly in the middle of the trade. And you tend to see tight trading ranges in some of the markets. I found, like the metals, the latter part of the US session, you tend to see that more often than not, doesn't mean all the time. Okay, so we're searching for trading ranges. Look at what happened here. Okay, market went up, double top. Now, I think I've mentioned before that when I'm looking at double tops, I like to see clear price separation, which means for me, at the very least, there must be 6 candles separating the one top from the other. That's like 30 minutes of trading. When it's too close, it's just I don't have enough information to make an informed decision. So here we're just above the threshold. Okay, so that's a double top, but we're not trading anything at that level. Okay, because it's set up. The double top is the setup. You gotta wait for the lower high. But what's happening on the other extreme? Well, we have a double bottom, right? We have a double bottom, slightly low. They're never always perfect. The bit of, like in this case, bit of a lower low, double bottom. That one was almost perfect. So you see it now, and you're saying, okay, I've got a trend range that is set up. If I look to the left, what's the market been doing? The market has been trending downward. Now it's created a bit of a trading range. So the bias based on where the market is coming from, that's a higher probability bias. At this stage is that I might get the market continuing to trend downward. That's a higher probability. That's the 60% chance that the market will do that. Now, remember I spoke of major trend reversals. This pattern, you could argue there's a major trend reversal from here. Okay, depending where you draw the trend line. Okay, the first thing is break off a trend line, close above moving average, attempt to close a prior test of a prior low. So at the same time that you have in your mind a higher probability bias of the market continuing a bear trend, at the same time you also have a major trend reversal alert in place. So you say, but George, how does that work? Well, the way it works is pretty easy. Remember we said major trend reversals. You can make a lot more money if you get in and you can build a position if the market reverses. But there are 40% chance of success. Because out of 10 trades, if you just focus on major trade reversals, out of 10 trades, you win 4, make your 3 to 1, by building up your position. You lose 6, and if you lose 6, if you trade on 1%, 6%, or if you manage it, you can lose half. But both are in play, and that's the thing about understanding price action. You gotta train your mind to say, what's happening for the bulls, what's happening for the bears, what am I seeing in front of me? So don't get locked in one way of thinking, because if you do that, chances are you are likely to miss a lot of opportunities. So now, with the bear bias, we're going for a lower high, and the first lower high would have a bit of separation. Would have been there, not triggered. There, put an entry in, would have been triggered. The stop has to stay there. Okay, and market keeps going down. If you didn't take that, we're going sideways. Another entry didn't get triggered. Then you get this attempt to test the double top, and then you get a lower high. That one you could put your stop beneath that, and so your entry beneath that, and your stop above that. If you're taking the earlier trade and put your stop plus or minus 1 or 2 pips above that, you wouldn't have been stopped out here. So you could have taken that, put your stop there, and what the reason you're taking this trade, okay, and trying to hold for the measured move. Remember our measured moves? You say, if market breaks, we're likely to get a measured move. Is because of what has preceded. And you know that you got a 60% chance of success for that, but you also know there's a 40% chance that the double bottom might hold. There could be a higher low that the bulls see, and the market could just go up against you. You get stopped out, that's fine, you know. Okay, so you take that trade, 60% chance of success you're looking out for, and you're trying to get to a measured move there, breakout, pull back, a little bit of a double bottom, but get a nice inside pattern. Still aiming for that, you can take that trade there, and you can put your stop in one of two ways. One here, higher risk than putting one stop there, aiming for that measured move, and also, but now you know there's many measured moves you could put potential. Okay, and the one closest to your entry is the most conservative profit target, and of course the one at the furthest is optimum profit. So somewhere within there you gotta take your profits, right? So that would have been a good trade if you were trading a major trend reversal. Okay, and this is a trading range, and you have said, okay, I'm trading a major trend reversal, and I ignore trading range, etc. I know it's a 40% chance of success with my double bottom. Now, in a bit of separation, let's wait for a higher low, close above the moving average. That didn't quite close above the moving average, so, not a good one to take. If you've taken it, it will end up being stopped. You want a proper close, remember, a major trend reversal above the moving average. But even if you've taken it, get stopped out, there is nothing to worry about, because you just say, oh, okay, 40% probability of success. I got stopped out. Let's see what's going to happen with the bears. You have built all of this up. Now you have the reversal at a hidden level of support. Perfect trade to take. Micro double bottom, that's a double bottom that's less than 6 bars apart. It is a reversal at hidden level of support. I just want to see how to get my trade. Close above moving average, not triggered. Next one, not triggered. There's the next one, triggered quite nicely. So, you would have been out, let's say 1% on one, and 3 pushes, 1, 2, 3, and you got out there, or got out there, you've been up 1.5 or whatever it may be. So nothing to worry about. If you're taking trades according to a strategy, nothing to worry about. Okay, here's an interesting one. We get these in the Asian session quite a lot now. It all makes sense, doesn't it? You tend to get on metals, I see. It also happens in currency, but I think more on sort of commodities than on currency. But if it also happens in currencies, it doesn't matter. If you tend to get a lot more tight trading ranges to the end of the US session, which means for the guys trading the Asian session, market might open a tight trading range, like we can see here. Absolutely beautiful, because when you do see the tight trading range, guys, you gotta have your flask of coffee ready. You don't want to be walking away from the charts because something is going to set up. There is absolutely no ways the day is going to end up like this. You can scroll through hundreds and thousands of charts. It ain't going to happen. There is going to be some form of a breakout. Okay. And if you just put, we could extend it for the sake of having fun. You must enjoy your trades to the US session. There's no way the market is going to end up like this for the next 24 hours. So you know something exciting is going to happen. So you need to just put all your thinking and trading together. And I know we haven't specifically delved into some of these. Are talking about the trading breakouts, etc. But I've shared enough of the principles for you to kind of look forward to these things. You gotta look forward to these tight trade ranges because they are opportunities. So What else did George tell us? He said, well, if there's a breakout of a trading range, market might get to a measured move. Okay, so while you are in here, put your measured move. Okay, can break out either way. You don't know. You're just waiting for the fund to start, right? So what we get a breakout. Okay, we get a follow through, very poor follow through. The bulls were strong enough to put this breakout candle. Why are they letting doubt creep into the market in the form of a doji? Okay, you gotta be saying, well, listen, maybe something might happen at the measured move. Already we had a strong bull candle testing the measured move. Okay, let me remove that. Okay, so the information is there once you start to bring these things together. It's not just a random why is the market turning there. There's a measured move there. Okay, computers know there's a measured move. Guys, who's trying to break, guys say we're taking our profits, whatever, another attempt by the bulls to go. Nothing. Micro double top separated by less than six candles. Another bull attempt to break above that and fails. Now, once if you see that reversal at hidden support levels, the strategy I've taught you is that you wait for your first close. We need to move an average top above there and take it. Okay. And how far are you taking it? You've got to take it there. Okay. Test of that other hidden level of support. What I would do and what you learn to do over time, because you understand how these things work. When I see that, I'm going to put my entry order beneath that. Then, because this is a tight trading range, okay, macro double top. Whenever you see a double top, then a trading range. Micro less than 6 by separation, it's a tight trading range, okay, at the hidden level of support. So a hidden level of resistance in this case. So it is a trading range. Now that gives me an opportunity to decide where to put my stop. Okay, so I'm going to just do a measured move, put my stop above there. Okay, so entry somewhere down here, 38 pip stop on nice gold we're looking at, and aiming for that level of resistance or support now. So I don't know, 1.5% or less, whatever the case may be. Or if you take the trade here, okay, then your stop is here, not up there. So 38, probably just less than 1%, but still beautiful, right? And that's one trade occurring in the first part of the Asian session. I mean, so when I see this, when I'm up full of energy early morning my time, and I see the tight trading ranges, usually they've seen something happening. So I have a quick look at the market at the end of the US session. I just know something is going to happen. The market is not going to remain in the same absolute structure like this tight trading range over time. So you'd have traded that tight trading range, but not within the tight trading range. You're looking for a breakout. We're going to see what happens with the measured move. If the bulls are strong, guys, they put a bull candle, strong bull candle, smashes through that hidden level of resistance. Maybe another one, pull back. And then remember we spoke about pull back to the EMA. Then you wait for a pull back to the EMA. 10 EMA, if you get it, you take your trade, you stop beneath the tight trading range. So broad trading ranges, you can trade within, like I told you, tight trading ranges, you have to wait for the breakout and see what happens at the hidden level of support. So that's a nice kind of separation to have in your mind. Okay, trading ranges. Let's skip it. Let's have a look at this. Okay, you also get trading ranges in the form of pullbacks to the moving average. So I spoke of now just one of the tight trading ranges, which can occur anyway, but the open of the session, of the day, the open of the day, open of the Asian session, tallying in with the close of the US session. You can find your tight trading ranges, and that gives you an indication of where to go. In major trend reversals, you can get trading ranges when the market is going to indicate to you that it might turn. Bear in mind the 40-60 could be trend continuation. So you don't panic. You just wait to see what you see. If you take a double top, low high, anticipating a trend, bear trend continuation, absolutely beautiful. Manage it. If you take a major trend reversal, 40-60, where your friend sitting next to you having coffee saying, I'm not taking a major trend reversal, I'm taking a trend continuation out of this double top. It's fantastic. You manage it. It doesn't matter. The strategies work whichever way. But trading range is also okay when after a breakout in a pullback to a moving average. And what we see here is it's not the neatest, but these things happen in the market. So let's have a look at it. So the bulls attempted or they broke out above this. You would have said, oh, absolutely fantastic. Let me wait for the follow-through candle. Okay, then I get confirmation of breakout, and I'll see what happens further. But the market decided to go sideways in any case. Now, you gotta kind of say, well, where are the double tops, double bottoms, etc. Remember, your friend is the closest. Okay, so if you can't see things clearly, there is a pullback to the moving average. There is a double bottom. I don't think the 6 candles, so the double bottom could be here. Okay, so within there's a trading range, but we don't have a high low. Let's just look at it again. Okay, first you see from this candle to that candle, it's about 8 or 9 candles. So there is some form of separation, but I'm looking for, I gotta see my double bottoms. First pullback, market went past that, so I'm just gonna ignore that failed breakout. There is another low, so double bottom, and I need a higher low. I wouldn't take that, not enough separation, but it's good indication that the bulls are in control. I just gotta wait to see how I can get into the market. And we only get into the market at that point. Okay, and the market is going up. Get into the market at that point, because of test of the 10 EMA and stop down here. How far is this likely to go? Well, let's show you this. We did get there and more by the end of the day. Or let's look at what's the most immediate price action. Okay, you kind of say, well, I think the market will get to that. That's the measured move of a breakout above the trading range that I've got. So above trading range that I've got. So if you're going to take that trade, your first profit target is there. You're going to see what happens. The market might just get there and turn, and you may not get your sweet 1%. That's what 2/3 or whatever the case may be. But then it starts to do this, hugging the 10 EMA, which I've said is a sign of strength. Okay, so if you manage it, just let it go and see. You kind of get there and you can see all the sideways price action profit taking. That's where I would take profit. And if you want to manage your trade, let's pull up the stock first here, and you go past that, then there, and just wait and see whether you get rewarded before the end of the US session. Let me just check the question quickly. John, when the candles have no tails, is it time to pay really close attention? Every time I see them, I think it's a big money market move as a trick and nothing to enter the wrong direction. Is this the right idea? So John, it depends where it's occurring. I'm trying to find one. So there's one here. There is no tails. Okay, but what you gotta look at is where is it occurring? That's the question you gotta ask yourself. Where is this candle even if we had one here that we had no head, no tail, where is it occurring in the context of the strategy that I'm seeking to trade, or what's happening on the left-hand side? That's how you gotta analyze it. If it's occurring like this one, we kind of said, okay, the market is, okay, let's go back a little bit more. There is a breakout candle, right? If the bulls are strong, I'm looking to see, looking for another breakout candle. They don't give me a breakout candle. In fact, now we start to go sideways to the moving average. But in that going sideways to the moving average, there is no close that's happened beneath the moving average. And whether or not I go to my line chart, look at the closes, but I can clearly see there's no close to the moving average. Then the key thing to watch is what's happening with the indicator of strength, which is a 10 moving average. So now we have this clean shaven candle occurring here. And the question is, well, let's just look at all these tails. Now we have one candle. What do I do at this stage? Well, in any of our strategies, there's nothing that we do. Okay, we don't buy above the breakout candle at all. Okay, if it was a follow-through candle, still clean shaven, we don't buy above that. We gotta wait for the pullback to the moving average. So if I get a pullback to the moving average, let's say that one, if it's clean shaven, it doesn't matter who's creating it. Okay, the context of what I'm trading, my strategy, I've had this breakout candle, and now I have a pullback, just bouncing off the 10 EMA, clean shaven or not, I'm gonna take the trade. So you've got to analyze it in the form of the strategy, whichever way it forms. If it's in the direction of the strategy, the way I would tend to look at it, once in light of what's going on to the left, is that the bulls, in this case, they are strong enough to jump in the market right at the close and to push that candle all the way to the close. Why do the bears step back? Okay, the bears step into the market after that. Well, if they are strong enough to reverse that momentum, then I want to see a bear candle, follow through breakout candle. I say, oh, okay, the bears are strong. Then I want to see a pullback of some sort, so I get my double top or low high double top, and then trade it short. Okay, I hope that helps. Okay, so trading ranges. Let's keep looking at that. Okay. Well, listen. Let's jump to the euro. Look at something else. Okay. Trading range of the euro. Well, here's an interesting one. Let's present myself before. Here's a top. There is a double top. So that's a slightly lower high double top. Okay. And the bottom, market went up, came back. There is a low. There is another low. Just over 6 bars. So you know it will do. We can work with that. Now, what are we looking at? We gotta wait and see. Okay, so we had a measured move there. The market didn't appear to measured move. So the bears are pretty strong to prevent the bulls from getting there. But what you gotta wait for now is to see if you get a lower high. Okay, that's what you gotta see. You need at least enough information to get the lower high, double top, lower high. So let the market come, and in that, because now we have a double top, but we don't have any strong closes beneath the moving average. In the formation of a lower high, I want to see at least a strong close beneath the moving average. Then the bulls can attempt to resume it, and I want to see the bears failing that and creating a lower high. Then I'm going to take that trade, and I'll put my stop up here. So that's a pretty decent one to look out for. On the other hand, the bulls could come back, and maybe the bears try to break beneath that. The bulls could turn the market, indicate another double bottom. If you get that, fantastic. We need to see the market resuming up. We need to see at least one distant close above the moving average. Then we wait for our lower high, higher low, whatever, and stop down here. Okay. trading range, early morning. So you come into the market and you're watching this, and you say, well, where am I going to trade? I can't trade here, down there, or here, up here. So I'm going to wait to see what happens. If you do get a breakout, if the measure move, if you get a measured move, if you get a breakout, bulls breaking out, then I see what happens when you get there. If you get a breakout, bears breaking out beneath that tight trading range, I want to see what happens when you get to the measured move. Yes, so tight trading ranges give us plenty of opportunity. Let's look out for those things. Okay, so somewhere within here is our measured move. So we're not surprised. Okay, the market gets to that level and attempts to get out but fails. Now, here is the whole thing about bar by bar analysis. So you don't just close your eyes and wait to see what happened. Bulls try to break out, tail of the top, bit disappointing. If you're looking from a bullish perspective. But look here, we then create a little micro double top. You see that went up, came down, went up, came down. So a bit of a micro double top there. So there's a tight trading range that is formed there as well. So you gotta say, okay, if we break above that, the bulls may wanna get to that. Okay. But you have a follow through, candle follow through, we don't get a decent breakout, attempt to break out and the 10 right at that level. Okay. So the breakout of the tight trading range is now complete. Okay, bulls have shown their strength, they've gotten there. Are the bears strong enough? So here the bears, with a bit of a gap, there's another clean shaven candle, drawn to the question that you had. So in the context of what you have, it's not a surprise because we have gotten to the measured move of the tight trading range. Bulls couldn't get to measure move of that double top. So you're expecting a bit of bearish strength. So they're strong enough to force the market and create a gap. So that's perfectly fine, but we're not trading that. Let's wait to see what happens. We then go sideways. Sideways means what? Tight trading range. Or sideways means the trading range, not necessarily tight. It can be anything. Just pop in your closes, you can see that's an indicator of the closes. Just hugging the moving average. All it means that the bulls and the bears are in agreement that in that period, the price that you're seeing, the average price that you're seeing is an agreed price. Okay, there's a lot of trading and transacting taking place at that price, but there will be a breakout, just like with any tight trading range, there will be a breakout at some point. And we kind of waiting to see what's happening. We're saying, okay, we broke out of the tight trading range, but we came back, we testing it, failing to break through, testing, failing breakthrough. So I'm now going to try and find ways to get into the market, okay? Because the bears are not strong enough to put closes beneath here. And I got to see now, if I'm a bull, how I can get in. Now, how do I get in? Market comes, went up, came back in a tight trading range. So that's a lower low double bottom. Not happy with it because of the separation. I mean, it's less than 6 candles. So I'm going to observe it, but I'm not going to really get excited about it. Then there's another one forming right here. Okay. I'm still saying, yeah, I like it. I can see the bullish confirmation of price action. There's another one getting there. So I'm getting one attempt to break through, failed. The bears attempted, the trigger that sell failed. Another attempt, they failed. Another attempt, they failed. Another attempt, they failed. That's all information. Now, whether this was happening over 50 candles where you can see, okay, one attempt, let's go up, another attempt, let's go up, another attempt. It's the same information. We've got to train our eyes to see these things and also just wait. There's something else. Remove my measured move from here. Okay. This law is very important. That law is very, very important. Because there's a breakout. That failed the breakout. Okay, the bulls came back in the market and attempted and eventually put a measured move. But that law is important. So the law that failed the breakout, the bears are failing to get beneath it. They went to that law, but they were repulsed. They were kicked back. Why are they failing to put another law there, and create a tight trading range? So now I'm seeing, okay, micro double bottom, another micro double bottom. I've got 6 candles that I need for my separation. If I get a decent enough close above moving average, I'm just going to take a trade. Okay, you have to trade in a trading range. Trading ranges are never perfect, but look at where you're coming from. Okay, this information is absolutely critical for you to say, okay, I'm taking that trade. But your stop is down here, 5.6 or 6, and then you say, okay, if I get triggered into the trade, measured move of that breakout is somewhere there. So that's where I'm looking to take my profit. 5.6. If you're in the market, if you're not in the market managing it, just leave your entry there. If you're in the market managing it, when you see that, do not panic. Okay, why wouldn't you panic when you see that? Okay, so chances are, potentially, maybe your measured move was in the wrong place. Look at closes quite high. Not in the wrong place, it was not as precise as it could have been. Okay. But if you've got it there, don't panic. Okay, the fact that you lose some profit is not an issue. But if you get then a close beneath the moving average, close the trade. I mean, you won't lose money. You won't make money. You won't lose money. But wait and see this, because now, let me explain. Don't panic because. Don't panic because. That's your entry. We have a breakout that's triggered you in. Follow through candle. Okay, shaved one drawn again. In the context of what we're talking about, absolutely fantastic. We have a follow through, so we have a breakout, a strong breakout from there. And what you want to see is what is going to happen at the 10 EMA. Okay, so wait for that. If you decide to close your trade, that's fine. You optimize some profit, but you're going to train yourself to wait and be prepared for the thing to go against you and say, oh man, I could have taken whatever, 1.2 or 2%, but now I'm back to break even. That's fine, because you make more money more often than closing your trades early. Then look at what happens. There's a breakout to the EMA, inside candle. If you're not in the market, there's a trade to take, pull back to the moving average, stop down here, or here, it doesn't matter. Okay, and what you're hoping for is for the market to get up there, take that trade. Measured move of that trading range. Okay, got a high, got a low, so the trading range, and macro double bottoms here. So there's your optimum profit, there's your beautiful profit, high potential profit. So you could take that quite easily. Okay, so trading range, opportunity, that's today actually. And you gotta keep watching this. So here, instead of getting a lower high, this what time is it? 20 past. So that could end up as a double top, or it might just turn in the last few seconds and give us a breakout. Then it's a different matter. But if it ends up as that, we keep watching out for that lower high on the euro see if we can trade that. And remember, the potential also double bottom euro watch. Okay, trading ranges. So when you see the market like this, it's not confusing at all. It's just absolutely beautiful. I gotta laugh at myself because it took a long time to train my mind. So you kind of come in and you say, let's say you come into the European station, London station, somewhere here, and you kind of say, well, we could have traded. So there was a trading range here. Okay. Top, pull back, top. So that's a higher, high, double top. Okay. But it is a double top, but that high is low, is higher than that. So you kind of say, okay, I see that. 6 bar separation, fantastic. I'd love to see a decent enough lower high. I wouldn't take that. That's still part of that double top. And you kind of wait for it because the thesis is, this is where the market is coming from. So I had my bear trend. Market is broken up. It's created a lower high. There's a lower high. So lower high double top as well. So we could even market that one later on. But double top, you want to find where to get it. You don't get a decent enough trade. That's not a decent enough signal bar, because of the tail. However, if you decided to take it, you know where to put your stop. Okay, there's a double bottom, another double bottom, and if you want to say, well, let me look at trading this market break above the trading range, pull back, and again went above, giving a close above the moving average. You can see that that lower high, I'm still in a trading range. There's no decent enough entry for me to get in there. So as a bear, well, I'm not going to take a trade. I mean, it's beautiful, but at that point, you wouldn't have seen that. For any reason you think it's a major trend reversal, that's fine. You're now waiting. There's a double top for a decent enough higher low. You don't get a decent enough higher low. Bottom, double bottom, bit of separation, but that's not the one that you trade closing at the moving average. You want to wait for just a little bit more, so you don't get it. So no trade here, as beautiful as it looks. But looks what happens down here. We have a break beneath that reversal at hidden level of support. Okay, so now we're saying, okay, we have a reversal at a hidden level of support. Let's find ways to get into this market and see what can help us. What are we looking for? We're looking for a higher low after a reversal at hidden level of support. So market went up, came back. That's a decent enough higher low to take. Trading reversal at hidden support level. We take that trade, the stop is here, and you're trying to say, well, where am I going to take my profits? From the low to that high, a pullback, that's optimum level to take profit. Best case profits, of course, will be way up here based on that. We will take the profits there. So that will be a trade to take. If you didn't take that and you see this pullback, you're kind of saying, okay, that's another high low. You're still working off the high low here. Take a trade, stop here, or take a trade, stop here. So all of those you could take. But talking about trading ranges, and you say, okay, that's a reversal hidden level of support I could take. As a trading range, where would I take it? Because the market is going sideways. So there is a low. Every bar counts. Market went up, pullback, there is a low. On our way to see what's going to happen when the market gets there. That's what happens. 36 bars wait. Okay, 36 bars wait. So you see that, say, okay, fantastic. I need 6 bars to confirm that the information I'm getting. You see that one, so you have from this low, you have a higher low, double bottom in the forming trading range. Okay, so let's say that again. There is a low, that is a higher low, double bottom. Okay, that is from that low, and 6 bars later, that low is a higher low, double bottom. Failed to break beneath that. and that's fine. And here's a perfect one to have traded. Why is it a perfect one? So there is another low, another higher low. Okay, and you could have waited, get a better signal, you get it with that inside candle. So you could take that, or stop down here. If you didn't take that, there's another opportunity. Then you trade in out of the trading range. The market breaks out of it, tries to break beneath that, came back, get high one, second attempt. So first attempt to break fails. Second attempt successful. You could take that trade. And of course, you have plenty of your measured moves to take your profits. So it may, when you look back, you say, oh my goodness, what happened there? How could you trade? But as it's unfolding before you, and you're looking at each bar as it unfolds, and you're keeping a cool head, you will see, okay, there is a low. Every low is important. There's no insignificant low. It could be one that's easy to look at after 2, 3, 4 candles, and then it comes back and goes up. Beautiful. When those come, just celebrate. Have another cup of coffee. but it's the information that's in front of you. I mean, there's so many opportunities to take the trade and just hold until you get your profits. So tight trading range in the morning. Mark it up. Okay. You know, by now you know it breaks above that. What's going to happen at the level of resistance, level of support. So here it breaks out beneath that. You don't get much of a chance to jump in. Then it goes back, and now we are back into this trading range. Okay, test of the breakout, market comes back. Second test of the breakout, put it into beneath that. The stop could be here or here, and you could take that. Or reversal at the level of support. Very strong breakout. Let me wait for the second entry. Goes up, comes back. There's an entry to take. Stop here. Turns at the moving average. Remember, what you want is a close above the moving average in the breakout. Turns at the moving average, like, oh man, you close your trade, break even a little bit of a loss. All right, guys. So I trust you absolutely enjoyed that. So I think we've got enough. I mean, it's been 3 months. There's a lot of information in the archives. But what I really want to do now is let's start looking for trades that you've set up in the past 2.5 days. If anything sets up in our session, we'll trade. So there's going to be a lot of focus on how the things come together. So I can really get you guys to that level where you're comfortable with price action trading. Thank you, guys. Thank you, John. I appreciate your attendance, and all the other regular guys. I really appreciate it. We'll chat to you guys. I'm going to stay warm in Johannesburg. Thanks. Remember, pop in questions, guys. Thanks, Gary. Pop in questions to the administrators to help me. If there's something you want me to repeat, just say, hey, George, next week, just touch back again on reversal hidden level support or whatever, so that I can just manage it. But I appreciate you guys, and thank you very much. We will catch up next week. Over to the guys at the office. Thank you, guys.